Hello, this is a walkthrough of the second AAT sample assessment for personal tax. Okay, so hopefully you can see practice assessment 2. Make sure that you're doing the Finance Act 2020 version. So you work for DBQ, a small firm of accountants. The managing partner is concerned that some clients do not understand the importance of tax planning and incorrectly confuse this with tax avoidance. And for 6 marks, we have to explain the term tax planning with an example and how this is different to tax avoidance. I haven't been asked for an example of that, but I might stick one in anyway. So 6 marks, so I'm thinking roughly 3 marks to talk about tax planning, 3 marks to talk about tax avoidance. So tax planning first of all. So aim is to reduce the tax burden, but it is both legal and a term they often use is within the spirit of the law. So it's like as the law was intended to be followed. So you will use lawful allowances and rules to minimize amount of tax payable. So for example, you might take advantage of tax relief available on pension contributions, or make sensible use of savings and dividend allowances, maybe by investing in shares rather than putting money in a savings account. All right, so explained what it is, and I've actually given a couple of examples there. As compared to tax avoidance, so I would say something like it is technically lawful, but not in the spirit of law. Exploits unintended legal loopholes in the system. It didn't ask for an example, but I think it's possibly quite neat to put one in there. For example, creating head office of a business in a country with more favourable as Luxembourg. That's like Amazon. I won't mention any names. Is that how you spell Luxembourg? Or Ireland is another favourite one. Okay, so distinction between planning and avoidance. Evasion, of course, is the one where it is not legal. Part B, you have a client who is a self-employed builder and he provided you with his total expenses figure of 175,216, which you included in his tax return. The net profit declared on his tax return was 35,200. The client has left you a message saying he is worried as he has given you an incorrect figure for his total expenses. In calculating the total, he recorded an invoice for 3821 as 3812. Ooh, big wow, we're thinking. Right, so I'm just jotting down a few thoughts here. So the difference between those two numbers is only £9. I'll tidy this up in a minute. I'm just sort of thinking of some ideas. So what's actually happened there? So an invoice for 3821. So he's understated expenses, which means he has overstated profit. If he's overstated profit, technically he has paid too much tax, assuming he is a basic rate taxpayer. This would amount to 20% of 9. £1.80. Could actually put some figures in. So understated expenses, so under by £9. So why not? They've given us the figure so we can work it out. 175,216 understated. So that should be 175,225. Trivial amount. Client has disclosed. Wouldn't worry about it. Now that's not how I would have written this out. So what would I actually have written? So that would kind of be my thought process. So you could scribble that down on a piece of rough paper and then kind of put your answer together a bit more coherently. So you might say something like, the client has honestly disclosed the error. It amounts to understated expenses of £9, i.e. expenses should have been 175,225. And I suppose we could make a separate point. This means profit is overstated by £9, i.e. profit should have been 35191. Yep. This means tax would have been overstated, assuming the client to be a basic rate taxpayer. This would amount to 20% times 9 equals £1.80. Being such a trivial amount, no action would be considered necessary. I would say something like that. I did have a look at their answers when I was preparing for this, and I think they've put their overstate and understate round the wrong way. Please feel free to have a look at it yourself, but unless I'm going mad, I think they've just said they're understate and overstate for the profit and the expenses round the wrong way. But their figures are the same as mine, so I'm pretty confident they've just made an error there. So that would be your task 1. So moving on, task 2. So this is your benefits in kind cars question. So Jack was provided with the use of a company car. Table below shows all of the necessary information. Now you see it's very similar to the first sample assessment, except there's only one vehicle here. They seem to be quite keen on this hybrid business, so make sure you are comfortable with that. Jack makes a normal contribution of £10 a month, which pays for some but not all of the fuel. So he's making a contribution towards the cost of a car, £4,000, use of the car, £100, and is making some contribution for fuel. So this is a great question. It's testing loads of stuff here. So complete the following table to show Jack's taxable benefits for the car. So the first thing we need is the scale charge percentage. So I'm going to get up the table. So we literally read off. So we've got CO2 emissions of 45. So just check they are between 1 and 50, which gives rise to the hybrid electric data. Electric range is 60 miles. So you find, there we are, 60 miles, and you just read off the percentage. So 6%. And then we need to check whether we have to add the extra 2. So the car is registered before the 6th of April. So yes, we do have to add the extra 2%. So 6 plus 2 gives us a percentage of 8%. Okay, so let's put that into the answer. Taxable benefit on the car. So to calculate the taxable benefit on the car, we need to multiply the 8% by the list price, not the cost price, the list price. We would add on the cost of any extras, of which there are none here, and we can subtract up to £5,000 of capital contribution. So 60 take away 4 is 56,000. Multiply that by the 8% that we just worked out, and then he has it for 6 months. So times your answer by 6/12. He is making a contribution towards the use of the car, £100 per month. He has the car for 6 months. So we need to subtract £600. All right, so to recap my calculation, 8% times 56,000 times 6/12 minus £600, and that gives me an answer of 1,640. And then the fuel benefit. So remember, with fuel, it doesn't matter how much is being spent on it. It doesn't tell us that here, but sometimes they do as a red herring. So the fuel figure, the base figure is 24,500. So we need to do 8%, the same percentage, times 24,500, has it for 6 months, times 6/12. The contribution for the fuel is ignored. Okay, so 8% times 24,500 times 6/12 gives us 980. Part B. If Jack had not made the monthly contribution of £10 towards the cost of private fuel, and had instead increased his capital contribution to £6,000 towards the cost of the car, what would this have done to the benefit? Well, we know that the fact, him making the £10 contribution had no effect whatsoever. So changing that is not going to make a difference. But if he makes a bigger contribution towards the cost of the car, instead of subtracting the 4,000 that we had originally here, we know that we could now subtract 5,000. So we would have a lower list price, which means that the benefit figure will fall. Part C. Complete the following table by inserting the scale charge for 2021 for each of the cars. Scale charge percentage is just the percentage that we use for the benefit. So these are petrol, well, the first one's petrol, sorry. So again, let me just get up the table. All right, so we can move this around a little. Here we go. Part C we're on. Right, so we can just about see that there, I think, for the first one. So it's 138, so it's over the 55. So what we do is we round down to the nearest 5, so that's 135. Subtract 55 and then divide by 5. So that gives us 16. And then we add 14. It's not registered pre 6th of April, so we don't have to add the extra 2, and it's not diesel. So my answer, 16 plus 14 is 30%. The second one, if I move that over there, we can just about see, hopefully. So this one is registered early, it's diesel and does not meet the standard. Right, so 147 rounded down is 145. Subtract 55 and divide by 5. I've written down what that is, hold on. So 145 minus 55 equals, divide by 5 is 18. Plus the 14, plus the 2 because it's registered pre-April, and plus 4 because it's diesel and it doesn't meet the standard. So that gives me an answer of 38. But of course we know, don't we, that we cap these things at 37. So the answer to that one must be 37. You can never go over 37%. Part D, excuse me. Oh dear. Margaret had the sole use of a company van for the whole of 2021. The van is electric and does not emit CO2. There is 50% of private use of the van by Margaret. That percentage is actually irrelevant. As soon as there is any private use, then it triggers a van benefit. Remember, of course, for a van, just going to and from work does not count as private use. This has to be over and above that. So if we go back to our reference material, van charge, here we go. So the basic charge for having a van is 3490. But as you can see, if it's a zero emission van, it is 80%. So if I find 80% of that, it gives me an answer of 2792. There is no fuel benefit, but if there was, you would do exactly the same, 80% of the figure given in the table. Right, next one, task 3. Right, before I start this one, I'm going to put my hands up. There is one question in here where I cannot see for the life of me how they've got their answer. So this is a bit of a challenge for you guys. So if someone can see how they've got their answer, please tell me, because I've looked at it till I'm blue in the face and I cannot figure it out. So either they're wrong or I'm having a moment. So we'll see. Right, Fode is employed and received the following from his employer. So we've got a whole different dates, we've got a whole load of different benefits, and we are asked to complete this table to show the taxable amounts. If it's 0, we put 0, whole pounds only, and where applicable, the averaging method is to be used. That's the bit that I can't fathom. So let's see what you think. Right, so first one, it's asking me about a bonus. So Fode received a bonus of £1,500. This bonus was based on Fode's performance for the year ended March 20. Right, so what do I need to know about receiving a bonus or indeed any pay? I assess it for tax at the earlier of the date it's received or when I was entitled to it. Got to see the word entitled, which I don't see here. So therefore the date I received it is the relevant date. So 30th of April is in my tax year. The factor related to prior to the tax year is irrelevant. So 1,500 would be the amount to be taxed in the current tax year. Right, next one we're asked for is staff parties, plural. So you can see on the 30th of June, Fode attended the staff party, 120 per employee. And then if you look here, 15th of December, a Christmas party, £100 per employee. Now, if any one event goes over 150, then that means you've lost your exemption. But if there are 2 events, you just have to pick one to be exempt. So I'm going to pick the 120 to be exempt, and therefore £100 is going to be assessable. You don't add it up and then do the excess over the 150. It's per event. Sorry about this. Hang on. Something stuck in my throat. Never mind. Does it say that anywhere? Staff party or event. It says £150 per head, but as I say, that is for one event. So you don't add them together and subtract 150. You have to pick, and in this case, the £100 to be taxable. So it would have been better if they'd spent more on that one and less on that one, and then it would have been a small amount that would have been taxable, if that makes sense. Anyway, I'll shut up about parties. We can't have any at the moment, can we? Right, incidental expenses. So the rule around incidental expenses is it is an average of £5 per night. So the fact that one is 9 isn't necessarily a problem if we find the average. So if we do 4 plus 9 plus 3 plus 4 plus 4, divide it by 5, that actually comes out at £4.80 on average per night. So that is absolutely fine because it's £5 you're allowed on average per night. So that will be fully exempt, 0. Health screen is the next one. Here we are. Paid for all employees, that's important, to have a health screen. The cost is £250 per employee. You're allowed 1 per year, as long as everyone is entitled to it. So that is an exempt benefit. So 0. Right, this is the one I can't figure out their answer, the loans. Right, so it tells me to use the averaging method. Please help me, what I'm missing here. Fode had received a loan of £5,000 on the 1st of January 20. So under £10,000 at the start of our tax year. He received a second loan of £8,000 on the 1st of December during our tax year. The loans are interest-free and Fode has not made any repayments. Right, so what I'm thinking is, right, at some point during the year, the loans exceed 10,000, so 8 plus 5 is 13,000. So that triggers the need to work out a beneficial loan benefit. So I use the average method, which is 5,000 at the start of the year. Oh, I've just seen what I've done wrong. I could not see this for the life of me before. Now I'm doing it live, I can. Right, so yeah, I know what I was doing. I was going 5,000 plus 8,000, average loan is 6,500, but it's not, is it? He starts off with 5,000, but he ends up with 13,000. So the average is 9,000. Oh, I can't believe I spent hours looking at this. Not literally, but anyway. So £9,000 average times the official rate of interest, which is 2.25%. So 0.0225 in the calculator, which is £202. Sorry, I'm so excited. Worked out the answer. Right, there we go. So did that make sense? So yeah, average is 5,000 at the start of the year, 13,000 at the end of the year. So the average of 5 and 13 is 9,000 times the official rate of interest. If you can't remember it, you can click on there, 2.25%. It's interest free, so there's nothing to subtract, which gives an answer of 202. Happy days. Right, mobile phones. Oh, incidentally, on that last one, in the calculator, it actually comes up as 202.5. With tax, just always round down. They have said that they'll give it either way, but just generally, if you round down, then you're more likely to be correct. Right, mobile phones. What have we got? So I'm just so happy I figured that one out. During 2021, Frodo had the use of 2 mobile phones. Both were mainly used for business and cost his employer £50 per month each. Don't know why he's got 2, but there we go. The rule is you are allowed 1 mobile phone. So the second one will be taxed as a benefit. So £50 a month times 12 months is £600. And then business mileage. So he's travelled 14,750 business miles and he's been given 45p per mile. Now we know that the first 10,000 are allowed at 45p per mile, but the remaining 4,750 should only have been at 25p per mile. So effectively he's got a spare 20p per mile on 4,750 miles. So I'm going to do 4,750 times 0.2 gives me 950 that needs to be taxed for excess business mileage. Quite a lot, isn't it? Is that right? 4,750 times 20p is, yeah, 950. Right, there we go. So that's that question. That's quite good. Right, so task 4 then. Samuel has employment income of £18,000. The only other income he received is the following investment income, which was paid directly into his bank account. Watch the wording on these questions. Employment income is before the deduction of a personal allowance. I don't think it makes a difference in this particular one, but just be careful with what the wording is and what you're dealing with. So what have we got to do? Calculate the tax payable on his investment income for 2021 by completing the table below. If your answer is 0, enter 0. So interest from bank and building society accounts, we've got to work out the tax payable. So we've got 1,200 plus 2,000, so 3,200. I can see without even adding it up that this is a basic rate taxpayer situation. If you take the personal allowance away from that and add these extra bits on, you're nowhere near 37,500. So if he's a basic rate taxpayer, we know that he gets a £1,000 savings allowance. So the first £1,000 are going to be tax-free, which means that the remaining £2,200 will be at 20%. So 2,200 at 20% gives me an answer of 440. Interest on an ISA account, an individual savings account, that stands for, is exempt, so that one's going to be 0. And then his dividends, it doesn't matter what type of taxpayer he is, he will get the 2,000 allowance. So only 7,900 will be taxed. Sorry. And we know that the rate for dividends, the basic rate is 7.5%. So 7,900 times 7.5% gives me 592.50. So I'll just put in there 592. Notice it says enter in whole pounds only. It doesn't say round to the nearest pound, subtly different with the rounding. So 592.50 for tax, we would round that down. Right, next part. 2 taxpayers each received investment income. Complete the sentences to show the amount each taxpayer will pay in tax on their investment income. Right, so this one looks a bit more juicy. Bobby received employment income of $47,500. Remember, that's before the deduction of the personal allowance. It would have to say other taxable income if it had already subtracted it. All right, so watch the terminology. So 47,500 subtract the 12,500 personal allowance means his taxable income, his non-savings taxable income is 35,000, right? So 35,000 is getting dangerously close to the 37,500 switch between basic rate and higher rate. His only other income is 4,200 from his building society account. So you can see that that's, what did we just say? We won 35,000. So 2,500 will be taxed at the basic rate. And the remainder, so 4,200, take away 2,500, the remaining 1,700 will be taxed at the higher rate. So the calculation you need to do, actually, just need to think about that for a second. We've also got the savings allowance, haven't we? So if we know that Bobby is going to hit the higher rate because he's going to go over, as we just saw, that means he's a higher rate taxpayer, which means he gets 500 savings allowance. All right, so your calculation, maybe on a rough piece of paper, needs to be that the first 500 of this will be at 0%. And if you imagine, you know, you were at 35,000 for your employment income, so that's you've kind of carried on your journey, so you're now up to 35,500. So that means that the next £2,000 of this will be taxed at 20%, because that's when you're going to hit the 37,500 ceiling. And then that leaves you with the remaining 1,700, which is going to be at 40%. All right, so you've got 500 at 0, which obviously equals 0. You've got 2,000 at 20%, which is £400. And then you've got 1,700 at 40%, which is 680. And if you add that all together, you get 1,080 as the tax. Right, last bit. That was quite nasty, that one. Henrietta received employment income of 80,000 during 2021. Again, it's employment income, so that's before the deduction of the personal allowance. Her only other income is 5,600 in dividends. Right, so even subtracting the personal allowance here, she's still going to be a higher rate taxpayer. So this one's a bit more straightforward. So the first 2,000 will be at 0. The dividend allowance applies to all. And then the further 3,600 is going to be at the higher rate. The higher rate for dividends is 32.5%. So the answer here is going to be 3,600 at 32.5%, which is 1,170. Okay, task 5. Mary rents out 2 properties during 2021. The details for each property are below. We've got rental income, we've got expenditure. Replacement of a boiler no longer working, so that's going to be allowable. Any sort of replacements like with like is fine. Replacement washing machine with an improved model. We should be allowed to replace it with a similar model, not an improved model. If we look here, it tells us the same model would have been 1,050. So that would be the allowable figure, not the 1,200 that she spent on the upgrade. The only exception to that seems to be double glazed windows. So let's have a look. So tenants occupied main road for the whole of 2021. And then we've got some stuff about the tenants of London Street. So let's have a look. Right, so her taxable rent for main road. So it's £300 payable on the 1st and tenants occupied for the whole year. So we can just do 12 times 300. Which is 3,600 of taxable rent. And we are happy that replacing the boiler, that's a very cheap replacement of a boiler, but there we go, of £500 is allowable. Okay, London Street. So we've got 450 on the from the 1st of April to the 10th of June. They left owing rent for June and Mary was unable to recover. So what she actually received during the tax year, so 1st of April was before the start of the tax year, so she received money on the 1st of May, but then didn't receive anything on the 1st of June. So she's only actually got £450 from those tenants. We've then got the second tenants paid on the 1st from the 1st of November for the rest of the tax year. So November, December, January, February, March, April, because the 1st of April is within that. So 6 lots of 500 is 3,000 plus that other 450 gives me 3,450 as my taxable rent. And remember, we'd already said that the allowable expense is the 1,050 for the equivalent model of washing machine. Is this true or false? If Mary had incurred redecoration expenses between the 11th of June and 31st of October, so that's when her property was empty, these would not have been allowable expenses because at that time there were no tenants. That doesn't actually matter because if the property is available to rent, then it's still an allowable expense. If it had said in the question that she let her daughter live there during that time, then that would have become a non-allowable expense. But because it was available to rent, the fact it's empty doesn't matter. Amy first rented her only property on, this is someone else. Amy first rented her only property on the 1st of February for £400 per month. The tenants paid in cash on the 1st of each month. The only expenses were advertising costs of £100. Amy will make any election necessary to minimise the property income chargeable to tax. Right, so we've got that property allowance. I think it tells us about that up here, does it? Allowance. Oh, here we are, property allowance. I think it's just gonna, yeah, it's literally £1,000. That's all it tells us. So what that means is that she can elect to take the property allowance and deduct £1,000 rather than just this 100. So obviously the more she can deduct, the less tax she's going to pay. So that sounds like a good idea. So how much income do we have? So we've got February, March, April. So she's got £1,200 of income, the amount that's actually been received. If she just deducted 100, she would obviously have 1,100 of taxable property income, but she can use the property allowance, which will bring her down to just £200 of property income. Right, task 6. So this is your tax computation question. So in practice assessment number 1, it was a very detailed one where we had to adjust the personal allowance and we had pension contributions. We had a lot going on. In this one, it's given us Jonas and James, and it's asked us to do two but actually they're quite straightforward. So I'd rather have had this one than practice assessment one, but there we go. Right, so Jonas, income from employment, profits from property, no pension income, bank interest received, building society interest received. Individual savings account, that's an ISA, so that's exempt, so we do not include that. And then dividends received. So I guess we could do a pound sign there for a retreat. Right, so you should be getting used to setting them out in this format. Employment income straight from the question, 49,000. Property income, there was no losses brought forward to deduct or anything, so we just put it straight into the question. We've then got our bank and building society interest, so we could put them on the same line, I guess. 900 plus 800. 900. We've got our dividend income, which is 11,700. And then think about the personal allowance. So if I was to add up all of those, I can see it's not going to exceed 100,000. So there's no adjustment required to the personal allowance. So 12,500 to give me my total income. So add all them up, take away the personal allowance, comes to 64,900. Leave a gap, start working out the tax. So tax savings income, sorry, non-savings income, what am I on about? So non-savings income is going to be 49,000 plus 15,000, subtract the 12,500. So I'll probably just make a note of that 51,500 somewhere. I might even just stick it here for now. I'll rub that out before I submit my answer, but it's quite handy just as I'm working through. So I've got more than 37,500 of non-savings income. So I'm going to start with my basic rate. Incidentally, no gift aid, no private pension contribution, so no need to change the tax bands in this question. So 37,500 at 20%. 7,500. And then I guess I could show the examiner how I'm working out the next bit. So I suppose I could have done 49,000 plus 15,000 minus 12,500 minus the 37,500 that's already been taxed at 40%. Which is 5,600. So far I've taxed that 51,500, so I can sort of get rid of that now. That was just to help me out. We've then got our savings income. So savings income is our 1,700. We know we are a higher rate taxpayer. So the first 500 will be tax-free. Oops. We could say savings allowance as higher rates taxpayer. As much information to the marker as possible. And then we take our total savings income, which is 1,700 minus that 500 that we've already taxed. And we're going to do that at 40% because we're in the higher rate tax bracket already from our non-savings income. So 480, and then dividend, oh goodness, stop, dividend income. So the first 2,000 will be at 0%. Tell them why we've done that. Which means that, what's our total dividend figure? 11,700 minus 2,000. This is going to be at the higher rate for dividends, which we know is 32.5%. We can always check it in the tax tables if we can't remember. So what's that come to? 9,700 times 0.325 is 31525. So rounding down, 31552. Right, add up all the numbers, 16732. And I could label that tax liability. All right. And then we've got the same for James. It's a bit boring, really. It's no twists. Income from employment, income from pension, which is also part of your non-savings income, bank interest received, building society interest received, dividends received. I suppose on that other one, we could have made a note at the bottom for the examiner, ISA income is exempt, so not included, just to be on the safe side. Right, so then for James, we're going to do pretty much the same. Out of interest, was it the split of marks the same? 5. Oh, that Jonas is 7 marks and this one's 5. So it's even easier. Woo. Right, so we've got employment income, 14,000. We've got pension income, 8,500. We've got bank and building society interest, which is 550 plus 1,200. And we've got dividends. I'm just copying this. I prepared it earlier, just so I don't have to keep going up and down the page, but it's just copying the figures in, really. So take away the personal allowance. Again, you can see there's not going to be any adjustment to that because we're well in the basic rate band here. So net income for this guy, James, is 14,000. And then we come to the tax calculation, leave a gap, so non-savings income. So what am I going to do here? I'm going to do 14,000 plus 8,500, subtract the personal allowance. Let's put all that in brackets, in fact. And then I'm going to just check what that comes to. So 14,000 plus 8,500, subtract 12,500 is 10,000. So well into the basic rate band. 10,000 at 20% is 2,000. Then we've got our savings income. So a basic rate taxpayer we have here, net income of 14,000. So the first 1,000 will be at 0%. So savings allowance as basic rate taxpayer. And then, so show the examiner what we're doing, even though it's fairly obvious. 1,750 minus 1,000, still at the basic rate. So 750 at 20% is 150. And then we've got our dividend income. So the first 2,000 at 0% dividend allowance. Then 2,250. Take away 2,000, still at the basic rate. Remember, basic rate for dividends, 7.5%. So 250 at 7.5% is 18. Add that lot up, 2,168. All right, so tax computations likely to be 3 columns. They might have set it out slightly different, but as long as you're using it as narrative, workings, figures, then you will be fine. Don't worry if you look at their answer and it's not identical to this. As long as it's clear what's going on, then that's absolutely fine. Right, task 7. So this is your national insurance question. Bob is a sole trader and employs 2 people. As soon as I see that, I'm thinking employer allowance 4,000 needs to be knocked off. So if it says employs 1 or 2 people, that's a big clue that you'll need to deal with that. Not quite sure why their ages are given, but there we go. They're not apprentices. The benefits are not convertible into cash. Right, so again, quite nice. They've given us a gross annual salary. There's no fiddling about with months. There's no fiddling about with directors. So the total class 1 national insurance contributions by Joan. So I can never remember the rates for this, so I would need my reference material. Right, so for Joan, we are going to say, right, the first 9,500 is 0. She doesn't exceed 50, so we're going to do 26,000 subtract 9,500. So the excess is 16,500 at 12%. So that gives us a figure of 1980 for Joan. And then Ari, he is over 50, so nothing on the first 9.5. If I do 50,000 subtract 9,500 and then 12% of that, I get 4,860. And then the excess, the 3,000 that falls into this last band at 2%, 3,000 at 2% is 60. So add that 60 onto the 4,860, gives me an answer of 4,920 for Ari. So let's see if I can squeeze that in there, 4,920. Right, class 1 payable by Bob. Bob is the employer. So the employer lower figure is 8,788, and then anything else is at 13.8%. Right, so if we work out Joan's figure first, so the first 8,788 at 0, and then work out the excess. So 26,000 subtract 8,788 is 17212. Find 13.8% of that gives us 2,375 for Joan's class 1 employer NIC. All right, so 26,000 minus the 8,788 times 13.8%. For Ari, same method, so 53,000 subtract 8,788 gives me 4,4212, and then I find 13.8% of that, which is 6,101. So this is the bit where the fact there's only 2 employees comes into play. So Joan's class 1 employer's figure was 2,375. Ari's class 1 employer figure was 6,101. So if I add those together, I get 8,476 that Bob has to pay for these employees. From that, I can deduct the employment allowance. The employment allowance only comes off class 1 employer contributions. So minus 4,000 gives me a figure of 4,476. Class 1A is payable on the benefit. This is the easy bit, 6,781. Class 1A is just a straight 13.8%, which rounded down gives me 935. Okay. Okay, task 8. So task 8 is the last of the kind of income tax NI, and then the remaining tasks are your capital gains and your inheritance tax. So during 2021, Ben received employment income of 25,000, interest of 8,000 from a building society account with 200,000 invested, dividends of 750 from shares with 20,000 invested, private use of a company car. He paid £10 per month towards the use of the car. That's efficient. Ben paid nothing towards the fuel. That's the better way round to take advantage of the rules. But he does have a fuel benefit. His employer's paying for that for him. He's got incidental expenses for 5 consecutive nights away. He's got an interest-free loan of 4,000 from 1819 and of 7,000 for 1920. So combined, 11,000 is obviously exceeding the 10,000 threshold. 10th of April 20, Ben made his first capital repayment of 2,000 towards the second loan. So just in the start of the 2021 tax year. Right, so there's a lot going on there. Remember, this is the challenging question, the tax planning. So what we got here, identify the effect on Ben's tax liability if he had made each of the following changes. Assume that each of the 7 changes are the only change that Ben makes. And we've got to say for each one if it increases, decreases, or has no effect on his tax liability, how much tax he pays or owes rather. Right, first one. If Ben had paid £10 per month to his employer towards the cost of private fuel instead of towards the use of his car. Right, so we know that by making a contribution towards the use, it gets deducted and therefore you pay less tax. If he had paid it towards the fuel, we know that it's tough and it's ignored. So he would have lost the advantage of paying towards the use and gained nothing. So overall, he would have ended up paying more. Right, second one, if Ben had paid 25 per month to cover all the cost of private fuel, so if he reimbursed it totally, there would have been no fuel benefit. So that would have decreased his tax liability because he wouldn't have had that benefit anymore. So less tax. Don't overthink these with comparing the fact, he's made that payment. It's only asking you about the change in the tax liability. Third one, if Ben had repaid the £2,000 towards the second loan 1 week earlier. Right, so these are asking about 2021. So as it stands, so you had £11,000 of loan. If he'd made a £2,000 repayment just before the start of the 2021 tax year, that would have brought the balance down to 9,000. And at 9,000, it's obviously under 10,000 and wouldn't have triggered a benefit in the 2021 tax year. So that would have been a very sensible thing to do, which would have decreased his liability. Next one, if Ben had paid 1% interest on the second loan. So if he'd paid some interest, we would have had to have subtracted that from the benefit, wouldn't we? Because the benefit is only the difference between the official rate of interest and any interest actually paid. So again, that would have decreased his tax liability. Next one, if Ben had claimed £5 instead of £10 on the third night away from home. Right, so what we need to do here is that average thing again. They seem to like this point, don't they? So 3 plus 2 plus 10 plus 4 plus 5 divided by 5 is an average of £4.80. So therefore that would all have been exempt. If he'd claimed less there, it would still all have been exempt. So that would have had no effect because the average is under £5 a night. Right, next one. If Ben had invested £5,000 from his building society account into more shares, he estimates he will receive additional dividends of £200 and lose £200 in interest. So would it be better having interest? Oh, hang on, wait a minute, what did it say? It will receive, right, so would it be better having dividends rather than interest? So thinking about the savings and the dividend allowance, so he's getting £8,000 of interest. So even if he's a basic rate taxpayer and he gets £1,000 of savings allowance, he's far exceeding that. Whereas he has £2,000 of dividend allowance, which he's not fully utilising. So I think it would make more sense to have more dividends and less interest, so he would be using his dividend allowance and he wouldn't be losing out on any savings allowance. He would still be utilising that. So therefore, doing that would be beneficial and it would decrease his liability. Obviously, not taking anything else into account, just the straight swap. Right, last one. If Ben had invested £5,000 from his building society account into an ISA, well, ISAs are good news because the savings interest is all tax-free. Ben has not previously invested in an ISA, so he's not going to be over the £20,000 limit. He estimates he will receive interest of £220 and lose some from the building society. So it simply means he's going to be getting some tax-free interest. So again, that will decrease his liability and would be a good thing to do. Right, I'm going to pause this video here and split it. So the next video will cover questions 9 through to 13, hopefully, which is your capital gains and inheritance tax.